co-ops don't have anything unique about what they need to do financially. They have to make money. They have to have a strong balance sheet. They have to have liquidity, working capital in their balance sheet. So the business model is no different than any business model. The primary difference is how they distribute their equity after they've earned it. Those normal financial factors give them access then to borrow money from a co-bank or other sources of capital. Co-bank happens to be the largest premier lender to cooperatives across the country, but you have to have the performance indicators. You've got to have a strong equity position. You've got to be profitable. So in the 80s, what was really transpiring, I think there were a couple things. One is the general economy was really stressed. You had high inflation, high interest rates. And in the ag community, you had the added dimension of low commodity prices. And so grain elevators, cooperative organizations were dealing with those kind of stress factors like any other company. So the ones that had put away a few shekels over the years had strong net worth, so they could withstand that. But that was also stressful at the farm gate. So their members, their farmers, were also having their balance sheets ravaged. In many situations, they were out of their control. There were other economic factors. It might have been world issues or just commodity prices, whatever it may be. So you had that two-edged sword going on in the cooperative itself, and then the farmer members. The other issues that were going on there then was just attrition. The size of those businesses in an extremely stressful financial time could not compete. So it wasn't that they couldn't make some money, it wasn't that they weren't successful, they weren't making good business decisions. It was the economy of scale. They may have been a small elevator trying to compete with a train loading elevator. And the bank, all banks at that time were trying to juggle those balls to say, well, are you economically viable? And can you afford to take on enough debt to see you through these challenging times? So in the 80s, that was a real major transformation of the business structure and climate in essentially all of agriculture, and cooperatives were no different. They weren't any more stressed or any less stressed. It all depended on their financial strength going in, and others, not just cooperatives, but businesses, agribusinesses were losing a lot of money. So the equity was flowing out of the business. Farmers saw their land devalued, which is typically a large component of their balance sheets. So they had equity coming out of their personal balance sheets, albeit not always in cash, but the devaluation of their farms. And so the equity just wasn't there to sustain the viability of some of those businesses. Those were the compounding effects that you had in balance sheets in the 80s.